is Energia.com? So clearly we're talking about software. Did you guys buy this software? Did you develop it in-house? Start from ground zero, what it is, what the goal is, and then we'll start digging into the weeds and unpacking it.
Yeah, so it's a labor of love. It's been 4 years in the making. We first deployed it in a contractual role through Donovan Ventures at the ABS level. And as we got more familiar with it, and as we moved closer to commercialization, we actually acquired it through a company called DV Analytics, and its wholly owned entity is Energia. And so that's where we're doing all our marketing for oil and gas securitization, if you will, through an equity product, a floating income product. The goal is to just create transparency for the individual investor. We are looking for a clean way to offer access to oil and natural gas in the United States. Like you touched on, it's very hard to get something that doesn't have agency risk related to hedging and leverage and G&A and development. There's not a lot of clean ways to do it. We think the market, with the success of this product, begins to bifurcate, where you've got the production stream and you've got the development stream. And the mineral side of things will, you think about how do you evaluate acreage. It's got two components. It's got a PDP and an undeveloped. And we think if we can create a product that provides transparency to the broader investor market, we think the market we're talking about with direct investors is probably, U.S. household assets are close to $7 trillion. The commodity alternative program within that is about 5%. So you're talking about $300 billion of capacity, interest in things like this, with respect to oil and gas, with respect to timber, with respect to kind of that real asset portfolio, and a large, the real estate's almost in an entirely different bucket. And so if we can provide a medium or an exchange or a clearinghouse that says, hey, here is, with a high degree of probability, the performance of these wells into the future, what are people willing to pay for that? And so we've given the investor two options. You can buy through two classes of stock for each program, a class U, which will be unhedged, or a class H, which will be hedged. And so you can even begin to think about, sort of the
and for the hedge product, because that's interesting, because there's a lot of family offices, for instances, that don't like to hedge. They like the pure exposure. And then others just want built-in downside protection. Where's the happy medium on 50% hedge or 75 or 80%? I mean, that's typically driven by the debt that's taken on.
Yeah.
When a company's managing the hedge program, but
we put this solely in the investors. Yeah, this is solely in the investor's hands. If you buy the class U stock, it's unhedged. It's completely floating. But as we spend a lot of time with family office and the RIAs and BDs, there's a component that says, yes, we want exposure, but we'd rather take a lower return in exchange for less volatility. And so you got those groups to the class H, which would be it's a hedged class, and depending on the program, we will do that hedging at a 3 to 5 year period for 80% of the volumes. And so really, again,
you're basically you're just lowering the standard deviation of the return profile, and that's really what the investor's looking at. I'm making up numbers here. Do I want 7 to 20%, or do I want 11 to 13? Just right. And then that's their preference. Okay.